Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Gaza peace talks underway in the Middle East between Israel and international mediators. Axios reporting some progress was made on the first day of discussions, citing U.S. officials. This coming as Israel braces for a possible attack from Iran. Joining us now is Ambassador John Bolton, former U.S. National Security Advisor and former ambassador to the UN. Ambassador Bolton, thank you so much for being with us. I want to start with what you think of the recent talks underway and why you think Iran has not retaliated yet.
Well, with respect to the talks, the administration saying making progress, they've been saying making progress on these talks for about 4 or 5 months now. They never seem to get to the finish line. I think there's still enormous gaps between the Israeli position and the Hamas position. I'm not saying a miracle couldn't happen. It happens in the Middle East from time to time, but I wouldn't look for it. I do think Iran has hesitated to retaliate for the killing of Ismail Haniyeh, the Hamas leader, in Tehran. They need to strike back, I think, very strongly. They've been humiliated by what Israel did, killing this terrorist leader in their capital, in a secure compound, with a bomb planted 2 months before. It shows nobody in Iran is safe from Israel, including the supreme leader. On the other hand, the Iranian leaders are also intimidated by Bibi Netanyahu and Israel. I think this time they are worried that the U.S. will not be able to pressure Israel into a limited response, as Israel did after the 320 drone and missile assault on Israel from Iran's territory some months ago. Really, Iran is more intimidated by Israel than it is by the Biden administration. So they've got a difficult decision, how strong a response to make to restore their own very damaged credibility versus their fear of what Israel would then do to them.
Well, in April, when those 300 missiles were flying over, it was because of the U.S. defense that Israel was able to fend them off. And Ambassador, given your level of intel regarding Iran, how can they retaliate but also try to not strike this cycle of endless retaliations back and forth?
Well, let's come back to the April attack. Wall Street Journal and CBS reported that of the 120 ballistic missiles that Iran fired at Israel, 60 never made it within range to be shot down. They either blew up on the launch pad or crashed before they got close enough, which speaks to the quality of Iran's ballistic missile force. But if there had been 120 rather than 60 ballistic missiles in the skies over Israel, I don't think it would have been such a good performance. The cycle that's at work here is caused by Iran. Look, this is not a war between Palestinians or Gazans and Israel. This is a war by Iran against Israel, what they themselves call the Ring of Fire strategy. And as long as the current regime in Tehran is in power, seeking nuclear weapons, arming, equipping, training, financing, giving intelligence to multiple terrorist groups in the region, threatening not only Israel but the Gulf Arab states too, there's going to be conflict. And what's driving Israel and the Gulf Arabs closer together is they all see Iran as the main strategic threat, and they think the United States is feckless.
As these ceasefire talks continue, do you agree with the idea that Iran could potentially use those, if they were to ink a deal, use that as an off-ramp to not retaliate?
Well, they may want to use it as an off-ramp, but I think it would be a big blow to Iran's prestige. You know, they're not exactly stepping up here to take responsibility for what happened to Hamas after the October 7 attack. And they've also not been able yet to persuade Hezbollah to use its unbelievably large arsenal of missiles against Israel. So, as I say, I think it's the fear of further Israeli retaliation that has the Iranians intimidated.
With that retaliation coming from Israel, if Iran does do some sort of large attack, Ambassador Bolton, what is the ability of the U.S. and its allies to rein in Netanyahu's response?
Well, I'm sure that the Biden administration will want to rein them in. They've been afraid of this issue and the war in Ukraine dominating the news in the United States because it shows a world in chaos due to 3.5 years of American weakness. Really, what they would like to see is this go away until after Election Day, even though Biden's no longer running himself. You know, frankly, I think the lesson to be learned is that the prospect of a really forceful Israeli response, if Israel comes back at them, shows that a strong posture toward these rogue states is the way to go. And Iran has a lot to fear from Israel. It should have a lot to fear from the United States, but at the moment it doesn't.
And Ambassador, a lot of times when we're talking about this retaliation, even if Iran would like to do that without provoking a response, the question always comes into the fore: what is the likelihood that mistakes are made? Mistakes are made that escalate things further. And that there's been this conversation that it won't just be Iran this time, but Hezbollah as well. Are the odds for mistakes higher by involving proxy forces in the retaliation to the retaliation to the retaliation?
Well, look, I think you have to look at what the strategic picture is. There is a regional war in the Middle East now of Iran against Israel on 5 fronts. Hezbollah from Lebanon, Hamas in the Gaza Strip, the Houthis that have closed the Suez Canal, Red Sea passage, one of the most important commercial shipping channels in the world, closed effectively since October. The Shia militia in Iraq and Syria that have been attacking American positions, and Iran itself. And the question is, how do they dial up one or the other? Israel does fear Hezbollah's arsenal, which in public estimates, this is an extraordinary number, but public estimates are that Hezbollah has between 120 and 150,000 missiles, which would obviously be enough to overwhelm Israel's air defenses, and leads to the question, if they really think it's about to happen, might not Israel strike first? It's complicated. It's not mistakes. It's the fact that the leadership in Tehran is determined to destroy the little Satan. That's what's at work here.
Ambassador Bolton, yesterday we heard from former President Donald Trump, who you worked for. He said, I'm not looking to be bad to Iran. We're going to be friendly, I hope, with Iran. Maybe, but maybe not. But we're going to be friendly, I hope. We're going to be friendly. Do you know what Trump 2.0's policy towards Iran potentially will look like?
Look, he has no idea what it will look like. People who look at what happened in the first term and believe that it'll be the same in the second term, I think are mistaken. It's always possible. But remember, Trump almost met with Iran's then Foreign Minister, Javad Zarif, at the Biarritz G7 summit in August of 2019. Emmanuel Macron, the president of France, had Zarif in a villa in Biarritz, almost persuaded Trump to do it. The attraction to Donald Trump of making a deal with anybody is hard to quantify. It really goes off the charts, and it could be the same way in a second term. And that's why I think there's a certain amount of pressure on the Israelis, if they're going to do something, to do it now rather than to wait for the uncertainty of the American election.
Ambassador John Bolton, thank you so much for taking the time with us. Let's begin with the top story. The Goldilocks scenario is back on the table and fully embraced. Stocks rallying on strong U.S. retail and labor data, indicating continued economic strength. Daryl Cronk of Wells Fargo remaining cautious, saying this: the U.S. economy is slowing and the Fed should be cutting interest rates. They probably should have already cut in July. The burden of proof has now switched over in the market's eyes and is on the soft landing to prove itself. Daryl joins us now. Daryl, did you write this before this past week's data?
I did not. I actually wrote it yesterday morning. I think outside of markets' kind of vicious reaction last week and this, if you kind of double-click below the surface, there is disconnects here, right? The yield curve is disconnected. I think some of the consumer data is disconnected. We read, retail sales yesterday up 1%. That was, almost 6/10 of it was autos, right? The rest of it was food, beverage, which is stuff we all have to consume every day. So it wasn't like discretionary spend, right? It wasn't some big, element that showed that the consumers out there spending crazily, right, on this. And I think there's disconnect in the manufacturing data and the housing data. We got the National Association of Home Builders yesterday. Think about it this way: that came in at a 39. Right, anything below 50s, means that their outlook is poor for home builders. And yet home builder stocks are going crazy, right? I mean, they're up, setting new, basically all-time highs. So you've got all these disconnects that I think markets have to reconcile themselves with.
Let's talk about one particular disconnect in the bond market, where you have parts of the bond market talking about an economy that is in need of a lot of Fed support, and then you have other parts of the bond market that are suggesting that this is an economy that's quite robust. How do you understand and reconcile some of these discrepancies?
Well, I think you put it well earlier, right? Think about it this way. I wake up in the morning and the first thing I look at is the 2-year Treasury, right? Quickly, generally now, last couple of weeks, followed by the Japanese yen, right? Those are the two eyes-on elements. The 2-year Treasury at 4 to 4.25 does not sync with 9 interest rate cuts between now and next year. Right? The math just doesn't work. I mean, the Fed funds is a 5.25. You bring it down to, let's say, 4. That's 125 basis points of cuts. We have 100 priced in for this year alone, much less what we're going to do in 2025, according to the Fed. So we're right back into this camp of who's right, who's wrong. Is the yield curve right and the 2-year Treasury right at 4 to 4.25 and maybe grinding higher, or, are we going to get 9 interest rate cuts? We've seen this movie before. We didn't believe it at the beginning of this year on the 6 interest rate cuts, right? We said that would get walked back. We didn't believe it at the beginning of 2023 when the Fed funds futures priced in 3 interest rate cuts for the back half of 2023. Third time's a charm. There's no doubt the Fed will go in September. I just don't believe the 7 to 9. And if you get 7 to 9, it's a problem for the economy. That's the reason we're cutting that aggressively, right? It's not because we're soft landing this thing and we need 9 interest rate cuts to get back to our start.
I wonder what you make of duration and the level of the 10-year right now. We were having this discussion earlier with State Street, this idea that you're living in a time where the soft landing seems probable, at least for now. We're not falling off a cliff at the very least. This week. We'll talk again next week.
Yes.
And in the meantime, you have these policy proposals coming from candidates that seem to indicate a lot of spending. And you have fears about auctions and auctions that have tailed, yet it is a 10-year that is still below 4%. Mm-hmm. Does that make sense?
I don't think it makes sense. I do think the long-term kind of neutral rate of the 10-year is around 375 to 380, not very different from today. But just last week on the volatility, we had been, like most people, kind of crowded on the short side of the curve in our exposure and positioning. We basically took that positioning and we bulleted it, right? Not barbell. So in other words, we took money out of the long side, took money out of the short side, and went right to the belly of the curve because we think you're getting good value there. You do have to start biting in duration and take some exposure there if the Fed is going to cut interest rates, which we believe they will. We just maybe fade this idea that they're going to be able to cut as aggressively as what everybody else does. So you do have to go after some duration here. You can't just live on the short side of the curve, or you're going to get killed with reinvestment risk over the next 12 to 18 months.
Back to the fiscal policy outlook, though. Is the bond market just ignoring all these policy proposals?
For the time, yes. I mean, if you went, so if you take my neutral rate on the 10-year at 380, and then you, regardless of the candidate, right? The two things that I think are certainties post-November are, bigger federal budgets and fiscal spending and more tariffs, right? Those are the two things you can bank on, regardless of whether you get, Harris or Trump. And both of those put an upward bias into interest rates, all else equal, right? So I think you're going to see this continued, fight, these kind of 2 sigma moves in yields on a daily basis that we haven't seen in maybe careers of a lot of bond traders and people who manage money. But it may be the new norm. The volatility may now exist fully in the fixed income markets and not as much in the equity markets as we just keep the carry trade in the short vol, and we just drive the VIX down into, from 65 to 15, and we push the yen back weaker again, right? It's just, we're carrying on right now.
It sure feels like we're seeing a lot of once-in-a-career events just in the past 2 weeks. One of them being the yen, which you said you wake up in the morning and check. What does it tell you when you wake up on a day like yesterday after the U.S. data and you see dollar yen up 1 1/3% after just, again, a week ago, about a week and a half, we saw this huge appreciation in the yen, that we can get that firepower back with dollar yen.
Yeah, I think it's, last week was all about kind of vicious unwinds of the yen carry and the short vol leveraged trade, right? They're putting it right back on this week, right? I mean, and putting it on with a vengeance. And it's coming from the buyers, they're shorting the yen and they're shorting the vol or VIX, using that capital to go out and buy risk-on assets, right? And it's coming from all sources. It's coming from the hedge fund community, it's coming from institutions, it's coming from retail, it's coming from buyback programs that now we're getting to the end of Q2. Companies are using any weakness to aggressively step in with their buyback programs. So it's coming from all corners, and until you change that and you couple it with kind of August seasonal low liquidity, and it creates these outsized moves.
Let's just take a step back for a second. You said the volatility now exists fully in the bond market, almost more so than in the stock market. Has it affected the way that you position, where suddenly stocks become more of the haven trade and bonds become more of a trading game, sort of the sort of daily grind that you think of with day trading of stocks, not traditionally bonds?
Yeah, some of the worst performing returns at the asset class level were in the fixed income markets this year, right? Maybe up until about last week. But the Barclays Agg, which is your common domestic indice, is one of the few indices that still hasn't set a new all-time high. Everything else is pushing, all-time highs across the board, and the Barclays Agg has not given you much return over the last few years. They get enamored with the idea of I can now get 4, 5, 6%, on the short side of the curve. But when you actually get to a total return, it's pretty anemic and it's pretty bad. So it's pushed people to equities as kind of there is no other alternative, right? The TINA trade, and they just keep going back to that as a way to get exposure until you can't or don't, right? Until volatility spikes.
Is that how you're arranging things? Are you buying into the TINA and staying away from big risk in bonds?
No, I would say we're a little more balanced. So we used last week's weakness that we bought into small caps, right? When the Russell 2 came all the way down to 2,000, had a 10% full correction. We bought into high yield because we thought, at 380, 385 on high yield spreads, that was the highest or widest spreads of the year, right? That we finally got a chance to take a bite at some high yield in that environment. And then we moved out duration on the fixed income market. So, but overall, I think from equities to fixed income, we're slightly overweight equities, but nothing where you've pushed risk budgets or positioning out to extremes at this point. And I think that'd be a mistake, to be honest, at this point.
Well, we can get into why in a bit. Daryl Cronk, always wonderful to speak with you. Thank you so much for being with us. Daryl Cronk of Wells Fargo. Here's the latest. Kamala Harris set to pitch her economic agenda in North Carolina this afternoon ahead of the DNC next week. Harris and Donald Trump both looking to put the economy front and center. Noel Dixon of State Street Global Markets warning, quote, this could turn out to be a race to the bottom as it relates to fiscal irresponsibility. I think it's difficult to see how there is not a floor under the long end of the U.S. curve regardless of who wins. Make bond auctions great again. Noel joins us again now. Noel, thank you so much for being with us.
Sure.
I want to start there.
Yeah.
It seems like people have forgotten about this storyline, and it seems like it only gets reprised when there isn't a lot of other types of drama in the market. Why is it not just a convenient boogeyman to pull out when people don't seem to have that many worries?
Yeah, I feel like, right now the market is certainly focused on different elements that it's a lot coming at once. And I think right now the main focus is, or the concern is, both candidates seem to be wanting to embrace or add to the fiscal spending tab. And that is what I think most people are going to be focused on and keeping an eye out on. And it gives them trepidation about going fully into the bond market, especially into the long end. So from what we experience, it seems people are more focused on more the belly of the curve, staying on the short end of things, because there's just a lot of uncertainty. And we're certainly going to get, I think, a risk premium baked in as we get into or approach the election.
Noel, when it comes to some of this rhetoric that's being thrown around, Kamala Harris today is going to talk about $25,000 if you're a new home buyer. Of course, you need Congress. So that feels like rhetoric. But Trump tax cuts are back in play. He's talking about a lower, his words, lower class, middle class, upper class tax cut across the board. Is anyone in these parties serious about ratcheting back fiscal spending?
I don't think so. I think right now, we've been able to sustain these high levels of debt, and they think, the music will continue to play. But I think, we're at a very different starting point. And this is what I think markets and investors are starting to get concerned about. We see it with some of the activity. And like I mentioned before, I think a lot of this risk is going to start to get baked in post-Labor Day. And I think we could expect some volatility.
To borrow a phrase from Lisa, are you expecting potentially a Liz Truss moment? Is that what it would take, the market to push back on the U.S. federal government?
I would say that's what it would take. I don't think we'll get to that extent, just to be fair. I think, we are still the reserve currency of the world. I think we still have very deep capital markets. However, I do think we have to expect that we're going to get some volatility leading into November.
I mean, it is pretty remarkable that we have everything you're saying. We've seen some bond auctions tail. The deficit's going to get worse. The economy isn't falling off a cliff, but 10-year yields are still below 4%.
That's right.
What is fair value to incorporate the fear of rising deficits in the U.S.?
Yeah, I think fair value is definitely higher than 4%. Right now, I think you have to juxtapose the fiscal concerns with what's going on with central banks. And there was, up until I would say yesterday, until we got retail sales, there was this concern that, the U.S. economy was starting to roll over. But as we see, the labor market is still tight. The U.S. economy is still relatively strong. So you have that environment. You augment that with some fiscal spending, and I think that's where you get above 4% and stay there.
Well, people have pointed to this idea that there's going to be less fiscal support than there was in the era of the CHIPS Act, the Inflation Reduction Act. Bank of America puts it at about a 5% drop in U.S. government spending year over year. How are you thinking about the U.S. fiscal impulse at this moment?
So the fiscal impulse, I think you have to keep in mind the CBO projections right now factor in the lapse of the Trump tax cuts. So both parties are going to keep, Trump obviously wants to keep it full stop. But, the Democrats, they're saying, 400,000 or below are going to keep the tax cuts. You add on to that, they both seem to be on consensus in terms of no taxes on tips. That's another tab. So you can start to see it start to add up. Like she mentioned before, Kamala Harris is talking about $25,000 tax credit. I know she wants to probably extend some of the tax credits that they had during the Biden's tenure. So all of that's adding up, and I think it's going to definitely, like I said, cause some volatility.
Just to sort of underscore this whole point, are you basically recommending to State Street clients not to go into long bonds?
I think I would be definitely skeptical to go into the long side right now of the curve. I think it's more secure to probably stay on the short end. And the Fed may cut rates. However, given how like I mentioned before, the economy is pretty strong, I think rates will, the Feds, they only could go so far.
Well, how far would long end yields have to back up for you to recommend them against clients?
I think they would have to get to 5% for me to feel comfortable recommending long end at this stage, and that's the 10-year.
And this is entirely because of political concerns, not because of what you're seeing with respect to potentially preemptive Fed cuts and just where inflation might be long term. This is having to do specifically with the deficit, correct?
It does, yeah. I think it's completely the fiscal situation that we find ourselves in, and I think it's just going to get exacerbated regardless of who wins. How much pushback are you getting from clients? I would say it's kind of mixed. I would say it's mixed. Some clients are, all in because, their perspective is, global central banks are cutting rates, good environment to go into bonds. But some are starting to get concerned about some of the proposals that are getting floated around. I think they were caught off guard a little bit when Kamala embraced this, no taxes on tips, because that was something new. Now the thinking is, okay, what else could come to the fore? What else could be reintroduced here? So I think that'll, what she lays out later on today, what she kind of emphasizes during the DNC will be critical.
Noel Dixon, thank you so much for being with us. Really interesting. Noel Dixon of State Street.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. and as always on the Bloomberg Terminal and the Bloomberg Business app.